If you've been looking at investing in property in Australia, you've probably thought about units due to the premium price that comes with houses in today's market. There's a pretty good chance somebody's already told you that units are a bad investment and you should stick to houses because land is where the value is. And look, I get where that comes from. There is data that supports that thinking. But here's the thing, now that we're in 2026, if you're dismissing the entire unit market, you could be walking straight past some genuinely great investment opportunities. So in this video, we're going to go through whether units are actually a good investment in Australia. I'm not going to give you a blanket yes or no because it's just not that simple. What I'm going to give you is the data and the practical framework so that you can make an informed decision on if it's right for you. Here's what we're going to cover. We'll look at the historical data of units versus houses. We'll go through why units got such a bad reputation in the first place. We'll look at where units have actually been outperforming houses right now. I'll walk through what determines if a unit has investment potential, and we'll finish with what the outlook looks like over the next 5 to 10 years. Before we get into it, my name is Nick. I'm a mortgage broker with Kingfisher Finance Group here in Brisbane, and I work with investors right across Australia, helping them structure their finance to actually build a portfolio. What I'm sharing today is general information. Everyone's situation is different, so make sure you talk to a qualified mortgage broker and even a financial advisor before you make any investment decisions. Here's a situation a lot of first-time investors find themselves in. You want to get into property investing. Houses in the suburbs close to major cities are sitting at $1 million plus. So you look at units and there's stock available at $600,000 or $700,000, sometimes even less. The rental yields look decent, and on paper, the numbers start to make sense. But then you do a bit of research, or you mention it to someone that you know, and you get the pushback that units don't grow, and you're buying a depreciating asset, strata fees will eat your yield, and there's not enough land value. Most of that is completely true, for some units in some locations. But in some cases, all of those statements are wrong. You just need to know what to look for and where to look for it. Because the problem is that often units get treated as one single asset class, when it absolutely isn't. A boutique 2-bedroom unit in a supply-constrained suburb 10 kilometers from the CBD is completely different to a 50-story off-the-plan tower in an oversupplied inner city corridor. Lumping them together is like saying houses are bad investments because you once lost money investing in a mining hotspot. So let's break this down properly. Let's start with the long-term numbers, because this is where the units are bad narrative can actually be supported. CoreLogic tracked the performance of Australian houses and units over a 25-year period. What they found was that over the long run, houses delivered average annual growth of around 6.8%, while units came in at around 5.9%. That gap compounds significantly over time. Houses grew roughly 412% over that period, while units came in around 316%. So yes, houses have historically outperformed units on capital growth, and the criticisms of investing in units aren't baseless. But here's the thing you need to remember. Almost every legitimate criticism of units is actually a criticism of a specific type of unit. Off-the-plan high-rises in an oversupplied location with a low owner-occupier ratio. And to be honest, I believe that these are almost always units that you should not be investing in. But before we discuss what type of unit you should look for, here's an insight to how different markets have been performing in the last couple of years, because we've started seeing some trends that are different to the long-term data. In the 2024-25 financial year, Perth's unit market delivered 20% growth in median sale price. Houses in Perth grew 16.4% over that same time period, meaning that units outperformed houses. In Brisbane, unit prices rose 18% in the year 2025. House prices grew about 12% over that same period. Again, units outpacing houses. Adelaide saw something similar. Even Melbourne, which had its unit market stagnate for several years, is showing real signs of recovery. So why is this happening now? There are 3 main things that are all converging at once. First, houses have become unaffordable for a growing share of the market. When buyers and investors get priced out of houses, demand flows to what is affordable, which is units and townhouses. Traditionally, in most parts of Australia, first-time buyers and investors would be looking to enter the market at around the sub 700k mark, with some being able to push closer to $1 million if they're in the financial position to do so. And not too long ago, you could quite easily buy houses within close proximity to some cities under these price points. So units and townhouses often had much less demand. But as house prices have grown out of reach for many people entering the market, all of the demand has flown into what's affordable, resulting in a rapid uptick in many unit markets that were once stagnant or declining. Second, new supply has collapsed. Apartment commencements across Australia are running well below what the country actually needs. Construction costs in some states have risen over 50% since 2020, making many new apartment developments financially unviable. So you've got strong demand running into very limited new supply. Third is population. Australia's migration numbers are at high levels, and a large proportion of new arrivals enter the rental market, with many of them opting for apartments. Add to that the ABS projection that single-person households will grow from about 2.6 million to around 4 million by 2046. Single-person households can typically borrow less and require less space, making apartments the more desirable property type. So now we've gone through the data, let's get specific about what you're actually looking for if you want to buy something that performs. In my opinion, one of the most important factors is buying in a supply-constrained location. You want suburbs where new development is genuinely restricted. Inner and middle ring suburbs of major cities where developable land is essentially exhausted. Scarcity is what drives long-term growth, and you can't manufacture scarcity in a suburb that's still being built out at scale. Second is building size. Boutique low-density complexes, broadly speaking under about 20 units, consistently outperform high-rise towers. In a boutique building, you typically have a much higher proportion of owner-occupiers. In a 200-unit tower, it's a very different dynamic. Many times I've seen multiple identical units for sale at the same time in the same apartment tower. These types of units have no scarcity, and compared to boutique complexes, these can go years without any sales in the building. This type of scarcity drives demand when one of the units eventually does become available. Third, and this connects to the last point, you want strong owner-occupier appeal. The best investment units are in buildings where people genuinely want to live, not just rent, where someone will choose to buy as a home because the emotion behind the purchase is what drives people to paying more. Fourth is the land component. Even within the unit market, the more land you can get per unit, the better the long-term outcome. It's much better to be one of 8 owners rather than one of 200. Land is typically a big driver of capital appreciation, so owning a larger portion of that land works in your favor. Hopefully this gives you an idea of what an investment grade unit looks like. And to make sure you also know the red flags, here are a few key things you need to stay away from when looking to invest in a unit. The first is off the plan units. I'll be as direct as I can here. Buying off the plan in an area where dozens of other apartments are also being delivered at the same time is one of the riskiest things a property investor can do. You're paying a premium price for something that doesn't exist yet, being delivered into a market you can't predict. It's extremely common to see these types of units being sold 5 or 10 years later for a similar or lower price than it was originally purchased for. Second is high-rise towers with low owner-occupier ratios. When a large percentage of a building is investor-owned, you are missing out on that owner-occupier demand, which, as mentioned, is a massive driver of the value. Owner-occupiers buy with emotion, whereas investors buy with their calculators. So if there's only investors trying to buy the property, it'll typically end in a lower sale price. And being in a building with so many other units also dilutes the demand due to the lack of scarcity. High body corporate fees are the next thing to consider. A pool, a gym, a theatre, they sound great, but always calculate your net yield after body corporate fees. I've seen buildings with these amenities have fees of $10,000 to $15,000 or more per year, which can significantly erode your net returns. Similar to this is underfunded sinking funds. If you're buying into a building that needs a new roof or a lift replacement in the next 5 years and the sinking fund doesn't cover it, you're inheriting someone else's problem in the form of a special levy. So always make sure there's an adequate sinking fund balance before committing to a unit. The last thing to avoid is pretty much anything that the lenders don't like, because there's usually a good reason they avoid them. This includes studios and sub 50 square meter apartments. Very small apartments face restricted lender appetite and they appeal to the narrowest possible buy pool when you go to sell. Serviced apartments is another one. Financing for these can be difficult and the resale market can be thin. This is worth knowing before you get excited by a high advertised yield. Now, what will the unit market look like moving forward? Because I think this is where the real opportunity sits for investors right now. As most people are well and truly aware, Australia is in a bit of a housing undersupply crisis, with new dwelling commencements running well below where they need to be. Paired with this is the affordability issues we are seeing for many buyers in the market. We are seeing most first home buyers as well as investors try to enter the market in the $700,000 to $1 million range. And as previously mentioned, most of the supply in this price point, especially at the lower end, is units. So where does that leave us? Houses are likely to maintain their long-term advantage in absolute capital growth. The land argument doesn't go away, but the gap between houses and units is expected to narrow. And for investors who can't access the house market at the current prices, well-selected units in the right locations are positioned to deliver competitive total returns over the next decade. Now, if you're watching this and you're starting to think a unit investment might make sense for your situation, the next step is usually understanding how much you can borrow. We work with investors every day and the answer genuinely varies depending on the property type, your income structure, and your overall financial position. If you want to understand exactly where you stand, what you can borrow, how a unit purchase might fit into your strategy, and whether there are any considerations you need to know before you start looking, you can book a free call with me and we'll map out your strategy clearly so you know exactly what you're working with. You can find a link in the description below, and if this video was useful, please hit like and subscribe. I'll see you in the next one.